Okay, so have you ever felt like completely overwhelmed by the sheer volume of economic news? You know what I mean? It feels like every day there's a new headline about inflation or interest rates or some financial crisis brewing somewhere, and all the jargon, right? It's enough to make anyone's head spin.
It's definitely a common feeling. It's easy to feel lost in this sea of information.
That's exactly why we do the deep dive. We try to cut through all the noise and get to the heart of what's really going on without all the confusing jargon.
Yeah, we aim to make complex economic issues understandable and relevant.
And today we're going to dive deep into a period that's had huge ripple effects on all of us. The Federal Reserve's actions during and after the 2008 financial crisis.
It's a story with twists and turns, and it's super relevant even today.
To guide our exploration, we'll be using Christopher Leonard's book, The Lords of Easy Money, How the Federal Reserve Broke the American Economy. This book provides some incredible insights into this pivotal moment in economic history.
And it's written in a way that's really engaging, even if you aren't an economist.
Right. The book really brings those key players and decisions to life. So think of this episode as your cheat sheet to understanding a really complex but crucial period.
Exactly. We want to unpack what the Fed actually did, why they did it, and most importantly, what it means for us, even now, years later.
Cool. So to kick things off, let's introduce you to a pivotal figure in our story.
Right.
Thomas Hoenig. Back in 2008, he was the president of the Federal Reserve Bank of Kansas City, and he was a voting member of the FOMC, the Federal Open Market Committee. That's the group at the Fed that actually makes the big decisions about interest rates and stuff.
Yeah, the FOMC basically sets the course for monetary policy in the U.S.
And what makes Hoenig's perspective so interesting is he wasn't some newcomer to the Fed. He'd been there since 1973, and he started out in bank supervision.
Right, so he spent decades examining the nuts and bolts of the financial system.
Yeah, that gave him a really unique perspective, a ground-level view that many others on the FOMC just didn't have. He saw the system from the inside out.
And it's that experience that really informs his perspective on the crisis and the Fed's response.
So let's set the scene. It's 2008, and Lehman Brothers collapses. It's like the whole financial system is on the verge of just imploding. The book uses terms like apocalyptic, a complete meltdown.
It was a moment of intense fear and uncertainty, and it felt like the entire global economy was hanging by a thread.
And this is where the Fed comes in. They have this superpower, the ability to create new money and pump it into the banking system. And after Lehman collapses, they start using this power in ways that had never been seen before.
The scale of their intervention was just mind-boggling.
It really was. Think about it. Between 1913, when the Fed was created, and 2008, the total amount of money in circulation, what they call the monetary base, had grown to $847 billion. But in the immediate aftermath of the financial crisis, it just explodes.
It's like a hockey stick on a chart going straight up.
Exactly. It just skyrockets. And this is where we see the different schools of thought within the Fed come into play.
You've got the hawks, who are worried about inflation and are generally against too much intervention. And then you have the doves, who are more willing to intervene aggressively, even if it means taking on some risk of inflation.
So where does Hoenig fit in all of this?
He's consistently a hawk, a voice of caution against easy money policies. He's very concerned about the long-term consequences of creating so much new money.
Okay, so we're in the thick of the crisis. The Fed is throwing everything it can at the problem. And this leads to a really important FOMC meeting where they decide to use this tool called Quantitative Easing, QE. What exactly is QE and how does it work?
So with QE, the Fed essentially buys assets. In this case, they were mostly buying U.S. Treasury bonds. They're buying these from primary dealers, which are like big banks, JP Morgan Chase, those types of institutions. And here's the key. They're not paying for these bonds with existing money. They're literally creating new money out of thin air and crediting the bank's accounts with it.
Whoa, that's like kind of a wild concept. They're just conjuring money out of nowhere.
It's a pretty radical departure from traditional monetary policy. Instead of just influencing interest rates, they're directly manipulating the money supply on a massive scale.
So the banks now have all these extra reserves, but what's the ultimate goal here? Why buy all these long-term government bonds?
The idea is that if they flood the system with cash and they make those safe, long-term investments less attractive, it'll push investors into riskier assets, things like corporate bonds, stocks, real estate. And that, in theory, should encourage lending and investment and boost economic growth.
Right, because if banks have all this extra cash sitting around, they're more likely to lend it out.
Exactly.
But this is where Hoenig starts raising some serious red flags. He's dissenting from these policies. He's worried that keeping interest rates so low for so long could create new asset bubbles.
He's drawing parallels to the dot-com bubble in the late 90s and the housing bubble that led up to the 2008 crisis. He thinks the Fed played a role in creating those bubbles by keeping interest rates too low for too long.
And he's not afraid to say it. The book quotes him from an FOMC meeting where he says the Fed bears a great deal of responsibility for the 2008 crisis because of their policies in the years leading up to it.
He's basically saying they're repeating the same mistakes, and it could have disastrous consequences down the road.
And all of this is happening against the backdrop of some pretty intense political turmoil. It's 2010, the Tea Party movement is gaining traction, and there's a lot of anger directed at the government for intervening in the economy.
It's a fascinating juxtaposition. You have this rising anti-intervention sentiment in the political sphere, while at the same time the Fed, this seemingly independent institution, is engaged in the most massive intervention in its history.
And it's really interesting to dig into Hoenig's background a bit to understand where he's coming from. His dad owned a small plumbing business, he served in the military, and he studied economics, focusing on regulatory systems.
You can see how that background shaped his worldview. He's got this deep respect for small businesses, for the real economy, and a strong belief in the importance of a sound and stable financial system.
Right. He's not some ivory tower academic. He's seen firsthand how the economy works on the ground level.
And he's worried that the Fed's actions are actually making the system more fragile and less stable in the long run.
So let's zoom out for a moment and think about the Federal Reserve itself. It was created in 1913, and from the beginning, there's this tension built into its very structure. There's a need for a central bank, but also this deep-seated American suspicion of concentrated financial power.
It's a delicate balancing act. It's part government agency, part private institution. It has a central authority in D.C., but also these regional banks. It controls the money supply, but it has to work within the existing banking system. It's designed to be somewhat independent from political influence, but still accountable to Congress.
Right. It's like this really unique entity walking a tightrope between public and private interests.
And that tension is constantly playing out, especially during times of crisis.
So before he became a voting member of the FOMC, Hoenig spent a lot of time as a bank regulator in the Kansas City Fed District. What was he seeing during that time that might have influenced his views on the 2008 crisis?
Well, he was right in the middle of the savings and loan crisis in the 80s. And the book talks about how he was constantly butting heads with local bankers over asset valuation. His team was trying to make sure banks weren't taking on too much risk, while the bankers were often more optimistic about the value of their holdings.
You can already see those early signs of disconnect between what regulators were seeing on the ground and what was happening in the broader economy.
And it's not just the 80s. Even back in the 70s, when Hoenig was a young regulator, he was seeing this tension between what his team was trying to do and what the FOMC was doing. They were trying to keep the banking system safe and sound, while the FOMC was keeping interest rates low, which was actually encouraging riskier lending.
It sounds like a recipe for disaster. And it kind of was, right? We had the great inflation in the 70s.
Exactly. And it took Paul Volcker coming in as Fed chair in 1979 and dramatically raising interest rates to finally break the back of inflation. But those actions had a cost. Asset prices crashed. We had a banking crisis. It was a painful process.
And then in 1991, Hoenig becomes a voting member of the FOMC. Alan Greenspan is the chairman at the time. And the 90s presents this really interesting economic puzzle. We have a recovery, but unemployment is actually rising initially. What's going on there?
Greenspan's view was that the economy was still dealing with a hangover from all the debt that was accumulated in the 80s. Businesses and consumers were still trying to pay down their debts, which meant they weren't spending as much, which was holding back job growth.
So it's like this vicious cycle. Cheap debt fuels a boom, then the boom goes bust, and we're left with a mountain of debt and a slow recovery.
And unfortunately, it's a pattern that we see repeating itself.
So how does Greenspan respond to this sluggish recovery?
He turns to easy money policies. He lowers interest rates to try to stimulate growth. And Hoenig, even though he votes with Greenspan initially, is still worried about the potential for inflation.
He's learned his lesson from the 70s.
He doesn't want to see the Fed repeat the same mistakes.
But then we get to the late 90s, and we have the dot-com bubble. The stock market is soaring. And interestingly, most people aren't really thinking of this as inflation. They're thinking of it as a boom.
It's this perception that asset price inflation is somehow different from regular inflation. And the Fed, under Greenspan, is kind of reinforcing that perception by not really addressing the bubble.
So they're focusing on keeping price inflation under control, but they're ignoring this massive asset bubble that's forming.
And the Fed ends up playing a role in both creating and bursting that bubble. They keep interest rates low, which helps fuel the bubble. Then, when the bubble gets too big, they raise rates, which helps to pop it.
It's like this boom and bust cycle, and the Fed is right in the middle of it.
And Greenspan's strategy seems to be to let the bubbles inflate and then come in and clean up the mess afterwards.
And after the dot-com bubble bursts, they keep interest rates low, which many argue sets the stage for the next bubble, the housing bubble. So we see this pattern of the Fed lowering rates after a bust, which then contributes to the next boom and the next bust.
It's like they're trapped in this cycle of reacting to crises instead of addressing the underlying issues.
Fast forward to the aftermath of the 2008 crisis. The Fed has just launched these unprecedented bailouts. They've pumped over $1 trillion into the financial system, even before Congress acts. And it's not just U.S. banks that are benefiting. The book reviews that a lot of this money went to foreign banks.
Right. They were trying to stabilize the global financial system, not just the U.S. system.
And the 2008 crisis left behind a lot of damage. Millions of foreclosures, a really slow and painful recovery. And all of this puts even more pressure on central banks to keep intervening in the economy.
It's like they become the only game in town when governments can't agree on fiscal policy.
And there's this quote from Paul Tucker at the Bank of England that really struck me. He said, "When elected politicians find it hard to agree on fiscal policy, the pressure to shift power to non-democratic institutions such as central banks is all the greater." It's a pretty chilling thought.
It raises some really important questions about accountability and the role of unelected institutions in a democracy.
Yeah, the public reaction to QE was fascinating. The book talks about this Fox News segment with Glenn Beck, which was full of misinformation about what QE was and what the Fed was doing, but it really resonated with a lot of people, especially on the conservative side.
It highlights the disconnect between the complexities of monetary policy and how it's perceived by the public. There was a lot of fear and anger directed at the Fed, even if it wasn't always based on accurate information.
So we're moving into the later stages of this story. We see Jerome Powell, who comes from a private equity background at Carlyle Group, and Ben Bernanke, who's the Fed chair, becoming really key players. And within the FOMC, there are these ongoing debates about whether QE is actually working and what the risks might be.
Even people like Powell and Betsy Duke are expressing concerns about the potential unintended consequences of these policies. But Bernanke is pretty committed to QE, and he uses what the book calls the announcement effect to maintain support.
What do you mean by the announcement effect?
It's the idea that by signaling their intentions, the Fed can influence market expectations. So Bernanke would hint at future QE, and that would often be enough to calm markets and keep things moving in the direction he wanted.
It's like this subtle form of market manipulation.
In a way, yes. It's about managing expectations as much as it is about actually implementing policy.
And all of this is happening while the European financial crisis is unfolding, which is putting even more pressure on the Fed to keep the U.S. economy afloat.
The global economy is so interconnected that problems in one region can quickly spread to others.
It's like this domino effect.
And the Fed is trying to prevent the whole thing from collapsing.
The book also points out that the Fed's own economic forecasts during this time were often way off. They were underestimating unemployment, overestimating interest rates.
It just shows how difficult it is to predict the effects of these unconventional policies. They're operating in uncharted territory.
And then we have the taper tantrum in 2013. Bernanke just hints that they might start slowing down QE, and the markets freak out.
It was a stark reminder of how dependent markets had become on the Fed's easy money policies. Even the suggestion of a change in course could send shockwaves through the system.
So let's talk more about Jerome Powell. He comes from this private equity background at Carlyle Group, which is a firm known for leveraged buyouts and using a lot of debt. And that's relevant when we start talking about this phenomenon called the search for yield that was driven by the Fed's low interest rate policies.
With interest rates so low, investors were desperate for returns. They were being pushed into riskier and riskier assets just to try to get some kind of decent yield.
So we see this huge growth in things like leverage loans and collateralized loan obligations, CLOs. It's like investors are chasing yield wherever they can find it, and they're willing to take on more risk to get it.
And this is where Powell's experience at Carlyle comes into play. He understands how this world of corporate debt works. He knows about leveraged loans, about the roll strategy, where companies keep refinancing their debt.
And we start seeing these Kovlite loans emerge. These are loans with fewer protections for investors. So lenders are basically giving out money with fewer strings attached.
They're so eager to put their money to work that they're willing to accept more risk. And this is creating a whole new set of vulnerabilities in the system.
Richard Fisher, who was the president of the Dallas Fed at the time, warned that QE was primarily benefiting the wealthy and private equity firms like Carlyle, not the average American.
And the book uses the example of Rexnord, a company that was acquired by Carlyle, to illustrate this point. Rexnord kept taking on more debt, but it wasn't really translating into more investment or jobs.
It was more about financial engineering than about actually growing the business or helping workers.
And they tell the story of John Feltner, a Rexnord employee, who's struggling to make ends meet despite the Fed's efforts to stimulate the economy. It's a really powerful example of the disconnect between the Fed's stated goals and the reality on the ground for many working-class Americans.
The book also talks about Hoenig's attempts to push for stricter regulations, what some call the Hoenig rule, and his concerns about banks not having enough capital. He's still sounding the alarm.
He's a consistent voice for stronger guardrails, for making the financial system more resilient.
But the search for yield isn't just confined to the U.S. It's pushing investors into riskier assets all over the world. We see it in the oil industry with fracking, in the government debt of developing countries. We even see negative interest rates in Europe.
It's this global phenomenon driven by this flood of cheap money.
Yeah.
And it's creating all sorts of distortions and imbalances.
And Hoenig keeps warning that unwinding all of this, getting back to some kind of normal monetary policy, is going to be incredibly difficult and potentially painful.
He thinks we're in a trap of our own making.
So Janet Yellen takes over as Fed chair, and she's got this unenviable task of trying to normalize monetary policy.
She tries to gradually end QE and start raising interest rates, but it's a delicate balancing act. The markets are so accustomed to easy money that even small changes can trigger big reactions.
And Powell himself, back in 2014, warned about the risks building up in the system. He talked about excessive debt and the potential for a sharp correction if things went wrong.
He seemed to understand the dangers, even as he was becoming part of the system that was creating those dangers.
And then we have Trump's presidency. His fiscal policies, his attacks on the Fed, just adds another layer of complexity and uncertainty to the whole situation.
It's like the Fed is trying to navigate this minefield of political pressures and market forces.
But Powell keeps pushing ahead with interest rate hikes in 2018. He says rates are still a long way from neutral. And then in September 2019, we have this unexpected turmoil in the repo market. Can you explain what happened there?
The repo market is this really important part of the financial system where banks and other institutions lend each other money overnight. And hedge funds were using it to leverage up their bets, especially through these trades involving Treasury futures. When the cost of borrowing in the repo market suddenly spiked, it threatened to blow up these trades and force hedge funds to sell assets, potentially triggering a cascade of selling.
So it was like this sudden liquidity crisis.
Exactly, and the Fed had to step in and inject a ton of liquidity into the system to prevent a meltdown.
It's another example of how fragile the system has become.
And it shows how difficult it is for the Fed to unwind these policies without risking another crisis.
So we're at the start of 2020. The Dow is at a record high. Hoenig is now at the Mercatus Center, but he's still warning about the Fed's trap. He thinks they're stuck in this cycle of intervention, and it's going to be really hard to break free.
He's worried that they've created a system that's addicted to easy money and can't function without it.
And then, of course, we have the pandemic. In March 2020, everything goes haywire. The markets are already jittery from the coronavirus outbreak. And then Saudi Arabia announces it's going to increase oil production, which sends oil prices plummeting. It's like the book says, a bubble in search of a pin.
And the pandemic was that pin.
And the Fed responds with even more unprecedented interventions. They launch another massive QE program. They create these special purpose vehicles, SPVs, with the Treasury to buy corporate debt, including junk bonds. They're doing whatever they can to prevent a complete collapse of the financial system.
They're pulling out all the stops. And in a way, you can understand why. The economy was facing this unprecedented shock.
And at the same time, Congress passes the CARES Act, which is this massive fiscal stimulus package. So you have the Fed and the Treasury working together to try to stabilize the economy. And some argue that these actions prevented another Great Depression.
There's a strong case to be made that their actions, as extreme as they were, prevented a much worse outcome.
But the question is, at what cost?
Right. What are the long-term consequences of all this intervention?
The Fed tries to spin its actions as being for the benefit of the middle class, but the book argues that the real winners were the wealthy, the people who own assets. They saw their stock portfolios and real estate values skyrocket, while many working-class people continued to struggle.
It's another example of how these policies tend to exacerbate wealth inequality.
And even former Fed chairs Bernanke and Yellen came out in support of Powell's actions. Yellen even said the Fed had become the lender of last resort for everyone, including the shadowy world of shadow banking.
It shows how far the Fed has expanded its role since 2008. It's no longer just about controlling inflation and managing the money supply. It's become this all-encompassing backstop for the entire financial system.
And the book brings back John Feltner, the Rexnord worker who's now an essential worker trying to navigate the pandemic. It's a reminder that while the markets might be booming, the real economy is still facing a lot of challenges.
It's easy to get caught up in the abstract world of financial markets and forget about the real people who are affected by these policies.
And even in March 2021, Hoenig is still warning about the dangers of all this debt, about the potential for inflation, about the Fed's inability to extricate itself from this cycle of intervention. He thinks we're headed for another crisis.
He's a lone voice, but he's been right about a lot of things. It's hard to ignore his warnings.
So we've covered a lot of ground here. We've explored the Fed's extraordinary interventions since 2008, the debates, the unintended consequences, the risks that are still out there. What are your key takeaways from all of this?
I think the biggest takeaway for me is that the Fed has become this incredibly powerful force in the economy, and its actions have profound and often unpredictable effects. And I think it's really important to understand how these policies work and who they benefit and who they might be hurting.
Right. We can't just blindly trust that the Fed knows what it's doing.
We need to be informed citizens who can engage in these debates and hold our policymakers accountable.
Absolutely. So as we wrap up this deep dive, we want to leave you with a question to ponder. What do you think is the most significant long-term impact of the Federal Reserve's actions since 2008? And what are the implications for the future of the American economy and financial system? It's a complex question, but it's one that we all need to be thinking about.
Because ultimately, these policies affect all of us, whether we realize it or not.